Amidst all the market chaos last week and over the past couple of weeks, JPMorgan just reported their Q1 results at the end of last week. We'll talk about what their Q1 results showed. We'll talk about the cautious outlook that Jamie Dimon and JPMorgan is taking regards to the economy, regards to the macroeconomic outlook and the consumer and your small business over in the United States, and whether or not you're individually invested in JPMorgan or you care about the banking industry. It's really, really important to take a look at a name like JPMorgan because they have so many touch points into the US and worldwide economy that it gives you a very, very good outlook on what to expect from the consumer, what to expect from small businesses moving forward. And like we said, JPMorgan taking a little bit of a cautious approach as the unemployment rate begins to tick up and maybe they're seeing some weakness due to tariffs and the policies coming out of the White House. They are taking a rather cautious approach. So we'll talk about what that means for the major US bank. Also talk about what that means for other companies set to report maybe in a few weeks. Hey guys, hope you're doing well out there. It's time to look at shares of JPMorgan Chase and Company, one of the most high quality banks. In fact, in my opinion, the highest quality bank you can invest out there. Shares up nearly 4% after reporting their Q1 results. Even over the past 1 year, shares have held up relatively well, up 20%. In fact, outperforming names like Apple and Google and Microsoft over the past 1 year. So we'll talk about why that outperformance is certainly justified, and we'll see the steps that JPMorgan is taking to position their bank in a maybe weaker economy with a more cautious outlook. Now, Q1 results came in very, very strong at nearly 10% revenue growth, up to $46 billion. That beat estimates on Wall Street by nearly $2 billion. The other important number that I like to take a look at when analyzing banks is the tangible book value per share. And that for JPMorgan up nearly 13% year over year, up to $100 per share. And if you don't know, the tangible book value is basically if you were to liquidate all of JPMorgan's assets, it would basically return to $100 per share. Now, at the current time, you're paying about $230 per share if you're investing in JPMorgan, but that's as you would expect. You tend to pay a little bit of a premium for a higher quality asset, and that's certainly what you're doing at JPMorgan. Now, at the current time, you're paying about 2.3 times a price to tangible book because, again, like we said, your tangible book per share is about $100 and shares of JPMorgan closer to $230 a share. Coming into the year, the price to tangible book and the valuation over at JPM certainly was stretched as you were closer to 3 times. Right now, you're underneath that 2.3 times. So in this market pullback, you did see a bit of a valuation reset over at JPMorgan. Now, historically, compared to itself in the past, over the past 10 years, JPMorgan's valuation still looks relatively stretched, as you would expect this one to trade somewhere between 1.5 as high as maybe 2 times a price to tangible book. I think if you can get this within that range of 1.5 to 2 times a price to tangible book, well, there your valuation makes a lot more sense with JPMorgan. And again, one of the reasons you've paid that premium in the past for JPMorgan is because you got pretty solid growth rates. I mean, over the past quarter, you got 10% growth. Over the past year, you've seen north of maybe 11, 12, 13% revenue growth rates over at JPMorgan. As we look ahead, those revenue growth rates are expected to slip into the low single digits, if not, in fact, go negative for a couple of quarters. And so as the growth rates begin to slip over at JPMorgan, stay relatively flat throughout 2025, well, then your price to tangible book, your price to earnings, and your valuation in general may not deserve a premium like it has over the past year. And so just keep that in mind. You like to see JPMorgan continue to raise their tangible book value per share, like we just saw 13% up year over year. Now, they did also reaffirm their full year net income guidance as they're expecting 2025 net interest income, excluding markets, to come out around $90 billion. And then when you include markets, at about $94.5 billion, the market estimates were closer to $94 billion as well. So despite the weakness that you're seeing in the current economy due to possible tariffs and at least the whipsawing of tariff policy coming out of the White House, despite all of that, despite possibly a weaker consumer and a weaker commercial banking side, JPMorgan still reaffirming guidance for the full year. They're not taking any premature decisions to lower guidance. And I think that's because the current news cycle is so volatile, because everything is changing so rapidly on a day-to-day, if not week-to-week basis. It's hard to take a stance on what the economy will look like 6 months or even 9 months from now. And so JPMorgan reaffirming their guidance is a slight good sign, at least for us as investors, trying to gauge what the economy will look like and at least what the banks think the economy will look like in 2025. Now, on the Q&A side of the conference call, JPMorgan's CFO and Jamie Dimon were asked a number of questions regarding the macro uncertainty as well as the economic environment that we're currently in. And JPM CFO did emphasize a cautious approach regarding spending patterns that they've recently noticed due to the transitional economic conditions. And then in regards to economic turbulence and the resiliency of JP Morgan, in particular, Jamie Dimon did mention the financial strength and the adaptability, but they did acknowledge that there's going to be potential impacts from a recessionary environment. Look, if the US slips into a recession, there's absolutely no doubt and no question that all banks, including JP Morgan, will see that hit to their financials, whether it's on the consumer side, whether it's on the commercial side, or high net worth individuals. A recession certainly will impact names like JP Morgan. But at the same time, you will have some banks come out and weather a recession better than others. And in my opinion, JP Morgan is probably the bank that will best weather a recession compared to other major banks in the US. They also were asked about the credit card charge-offs and maybe delinquency rates rising amidst a recession. And the CFO did explain that charge-off rates and trajectories are simply affected by unemployment trends, and they're relatively predictable in the short term. And I think right now, the unemployment is probably your best indicator in terms of seeing what the economy and what banks and JP Morgan specifically will do for the rest of the year. If you see the unemployment rate, which currently sits at 4.2% for the month of March, if you see that continue to tick up like we have over the past couple of months, if it continues to climb and hit that 5% unemployment rate, well, in the past, that's been a signal for a recession indicator, as in 2008, you crossed that 5% and you triggered a recession. In 2020, you also had a mild recession as unemployment really skyrocketed. So the unemployment rate, in my opinion, is really what dictates where the US economy will go. Certainly, if these tariffs continue to take place and there's no real negotiation and the tariff war continues to increase, well, businesses will absolutely be put in a tough position where they'll have to make the decision to perhaps lay people off. And at that point, we might see the unemployment rate begin to tick up, continuing to tick up from 4.2%. Again, that 5% mark, I'd say, is the indicator that if you hit 5% or at least get close to it, that's probably your sign that a recession is on the horizon. And again, unemployment will tell you how consumers are feeling in terms of taking out home loans, auto loans, paying back their credit card debts. It'll tell you where businesses stand in terms of hiring and laying people off. Generally, when a recession hits, you'll also see the markets take a turn for the worst. And so you'll see those high net worth individuals also reduce their deposits and maybe start pulling out money from banks as well. So again, the unemployment rate really dictates where the economy goes. As long as people have jobs, they're able to pay their bills, whether it's on their homes or cars or on their credit cards. And as long as people have jobs, they have disposable income, and that is a good sign for small businesses and other corporations as well. Now, overall, in terms of JP Morgan as a whole, this quarter came out relatively well. As you saw, your net revenues up nearly 8% year over year. JP Morgan also doing a very, very nice job controlling those non-interest expenses. These are your employee costs. JP Morgan managing that really well, as that was up just 4% on a year over year basis. But again, like we said at the top, this company is taking a very, very cautious approach and outlook for the rest of the year in terms of the macroeconomic uncertainties. And that shows up in your provisions for credit losses, as last year, your provisions for credit losses were just about $1.8 billion, up nearly 75% year over year, now sitting at close to $3.3 billion. So JP Morgan as a whole is maybe fearing that consumers will start to default on their credit cards. Maybe they won't be able to pay back those home loans or auto loans as well. And so they're needing to put aside more and more money as provisions for those credit losses. And look, it isn't just occurring on the consumer side. In a second, we'll see it's actually also impacting their corporate and commercial banking activities as well. But again, JP Morgan controlling those expenses, so you were able to at least grow your net income by right around 9% on a year over year basis, and then your EPS growing faster as this company is executing on that buyback. Now, from your consumer and community banking side, your net revenue staying relatively flat, up just 4% on a year over year basis, flat on a quarterly basis. You are seeing still growth on your credit card services and the auto side of the business. So at least for the first quarter of the year, the consumer is staying relatively strong, but as you see, the provisions for credit losses ballooned up 37% year over year. So JP Morgan, despite seeing a relatively strong consumer in Q1, they are taking the precautions for putting aside provisions for credit losses, perhaps in case the consumer weakens heading into the rest of the year. And certainly with how fluid the current trade war situation and any news coming out of the White House is, there is a chance that these provisions for credit losses don't need to get used up. Let's say the unemployment rate doesn't actually tick up, the US doesn't slip into a recession, well then these provisions for credit losses will just flow back into JP Morgan's bottom line, and in a future quarter you'll recognize that benefit. But as a bank, and especially during a time where the economic outlook is very uncertain, it's the prudent thing to put aside more money in case the consumer weakens, in case the tariff war continues to escalate, unemployment continues to tick up, and maybe inflation stays persistent. Well, as a bank, you have to take the prudent approach of putting aside more and more as provisions for those credit losses. And so that hurt your net income on the consumer side down about 8% year over year. On the commercial side, you are still seeing relative strength on the revenues, as those were up 12%. The markets and security services revenues up nearly 19%. Again, during the first quarter of the year, you had very strong global markets, and the markets really fell off a cliff in the first week of April, which again doesn't really reflect in the first quarter. That will be reflected in the second quarter of fiscal 2025. Now, similarly on the consumer side that we saw, on the commercial side, JP Morgan is putting aside a lot of money for those provisions for credit losses. Last year, they basically put aside nothing on those credit losses. Now put aside nearly $700 million as provisions for credit losses. So again, JP Morgan might be seeing that the small business, at least the businesses that are banking with JP Morgan, as they get impacted by the ongoing trade war and maybe as prices continue to increase for their goods and services, well, they might not be able to pay back some of those loans to JP Morgan. And so again, putting aside some of that as provisions for credit losses. Again, last year, you didn't have any of that. So this just shows the year-on-year change really should show you where JP Morgan's seeing the macroeconomic outlook for the rest of the year. And then lastly, on their asset and wealth management side, this is really the high net worth individuals. Also on the trading side of things, the revenues there up 12%, and at least for the first quarter, things still looking relatively well, as your net income up nearly 23% year over year on the asset and wealth management side. But again, overall, all things considered, you are seeing this company put aside a lot more money for those provisions for credit losses. And look, if they don't get abused over the next couple of quarters or the next year, well, then that will flow back in. But if you see the unemployment rate continue to tick up month over month, especially in the month of April, well, then that won't be a good sign. And you'll likely see the provisions for credit losses continue to increase over at not just JP Morgan, but all of your major US banks. Now, before we take a look at the technicals for JP Morgan, I did want to talk briefly about the technicals for the overall market. We've seen a very, very volatile time over the past couple of weeks. Again, as the policies out of the White House change on a daily basis, the market is trying to gauge and adjust on a real-time basis to how that'll affect corporations, how that'll affect small businesses, how that'll affect consumers maybe needing to pay higher prices. And so that's why you're seeing that volatile swing. Now, what I do want to point out is the fact that we have a nearly 2-decade uptrend with the S&P 500, that you only come back and test the bottom of the range maybe less than 10 times over the past 2 decades. You saw that test last week as the S&P 500 wicked through the $4,800 level. And look, as long as your investing strategy remains sound, as long as you stay true to all the principles you've built up over the past couple of months and years, you should have absolutely stepped in and bought this dip, because you're testing the bottom of a multi-decade uptrend. And certainly if you made that decision to step in and buy the dip, well, then you're looking pretty good right about now. So that's what I want to point out, is the fact that, look, when markets are downtrending and free falling, there's going to be 1,000 reasons out there to not buy the dip. There's going to be 1,000 news stories to tell you that the markets are heading lower and that maybe you should wait before stepping in and buying the dip. But if you look at the price action rather than the news stories coming out of CNBC or any other major news media, well, then during every time there's been panic in the markets, every time you've seen a nearly 15-20% correction in the S&P 500, it's been a clear sign to buy the dip. And this time certainly is no different, and at least was no different last week. So whether or not this was the bottom, whether or not we're going straight back up into a V-shaped recovery, or we continue to head lower from here, you just have to remember that when the markets get ugly, there's going to be 1,000 reasons to not buy the dip. You have to stay true to your strategy as long as you've researched and done your due diligence in high quality companies, whether it's individual stocks or it's the broader based S&P 500. When it hits levels where they enter a buying zone, you have to close your eyes and buy the dip. If you contribute weekly or monthly and you're buying on a consistent basis, these are levels and these are times where you increase your allocation and try to buy a little bit more, because you don't get these drawdowns in the markets very, very often. In fact, over the past 2 decades, it's happened just a handful of times. And so as the market becomes volatile because of the news stories coming out of the White House, these are opportunities to pounce on. And countless high quality companies will enter what is known as a buying zone, and you have to be able to go through that tough decision of buying the dip when others are fearful. A similar story with JP Morgan. Again, this company didn't nearly fall as much as some of your other mega cap tech names, and it actually held up much better. And so you did bounce off this top end of the range and you made your way near the middle end of the range. And certainly if you picked up shares of JP Morgan at that point, again, just basing it off the technicals, the fact that you were coming close to the middle of the range, that could be considered a buying zone. Well, then you're looking pretty good. And again, shares of JP Morgan at the current time seem a little bit stretched as you are near the top end of the range. Again, also the valuation is still a bit stretched at nearly 2.3 times a price to tangible book. If you continue to move lower with the broader market with shares of JP Morgan, if you move back down into the mid 200s, well, then you're at the middle of the range. That's a point where you continue to buy shares of a high quality name. Certainly if you get all the way back down to the bottom of the range near the 150s, that's a point where you step in aggressively and allocate your shares into JP Morgan. Again, when shares are nearly at 150, the news story will certainly be ugly. You have to make those tough decisions now, that when a high quality name gets to a bottom of a range, gets to a buying zone, you make the decision to buy that high quality name as long as the long-term story remains intact, which it certainly does with shares of JP Morgan. Your future self will absolutely thank you for it. That was my take on shares of JPMorgan Chase, along with the overall economy. Look, there's a lot of uncertainty in the markets right now. You have a lot of whipsawing and volatility. But again, as informed investors, volatility is the time where you can capitalize, as long as you keep your head on straight and you don't get rattled by the news stories and the policies coming out of the White House every single day. You stay true to your disciplined investing strategies. You continue to research high quality names. You take a look at the technicals to tell you levels of possible support and resistance, and you act on those buying zones. Well, then you'll do just fine. Let me know your thoughts on this one in the comment section below. Next week, we'll have some semiconductor names begin to report. I believe you have TSMC along with ASML, and then as well as Netflix at the end of Thursday. And then after that, you'll have all of big tech reporting as well. Stay tuned here on the channel. We'll be sure to cover those for you. Thanks so much for listening, and I'll catch you guys in the next video.